Hello, welcome back. We have some news from Walgreens, and this is why I'm making this video. They reported earnings, and we're gonna examine the company, see whether the financials are looking good and whether it's a good addition to a portfolio. Now, obviously, this is a massive company. It has more than 200,000 employees here. And notice that the beta of the company is less than 1, and it's 0.6, almost 0.55, which means that it is much less volatile than the market itself. So this means that if you are a long-term trader, this is probably a long-term holder. This is probably a good thing for you because the stock doesn't move that much and it's a little bit of a boring one, which you would expect to slowly rise over the years. Now, if you're a trader, though, you may want to avoid this because, again, it's not very volatile and you could end up having to wait, over your computer for a long time. So, yeah, that's worth noting. It's a very, very useful attribute to know about. Now, we will take a look at the news first. You will see that Walgreens was reporting on earnings, and they did report, and they beat on estimates. They beat earnings expectations after Omicron fueled demand for tests and boosters, pretty much lifted sales. Very, very interesting, but we're gonna be examining the company as we usually do. Let's take a first look at what the company has been doing. That's the last month. Again, you will see that the company was like 45, and then in a month it has reached like 47. It doesn't move that much. And you will see that in the last 5 years, again, not insane. There has been some movement, of course, but it's not like this company will be, moving way too much over the years. And so remember, this is a 5-year period now. It's been down though, so that's worth noting. It's been down last year about 16.8%, it looks like. So it may be an interesting opportunity to buy because of that, because the high used to be like 85.13 was the high. So the P ratio of the company here, in regards to the earnings of the company, it's much, much lower than what it used to be in 2020. That's a good sign. Means that the company's stock price has fallen down a lot, yet their earnings haven't declined. They may have actually increased. We will examine that. And the price to free cash flow ratio, another check mark here. Again, it was higher, still relatively low, but now it's sitting at 10.1. So that's very, very favorable for an investor here. The next thing, outstanding shares down 20%. Another great thing from, what was it, like almost 1 billion to 863 million here. Now, the next thing that we want to examine, of course, is the 5-year revenue growth, net income growth, and free cash flow growth. And this is a little bit of a more worrying sign here, the net income growth. It's been stalling a little bit. Now, that doesn't mean that it is negative, but it's been down from what it used to be. It's still positive, but down. Same thing with the 5-year free cash flow growth, as you can see, and used to be about 4.1 and went down to 2.78. Worth noting. Now the price to sales ratio is much lower than than what you would expect is 0.3, very, very good one, and the debt to equity ratio is a little bit elevated, but again, it's not something that I would be too worried about. The current ratio is also slightly less than what I would like it to be, because this means that the current liabilities are more than the current assets. That's the 12-month assets compared to the 12-month liabilities. The return on equity, though, is very good, 28% here, very, very good. And a dividend yield of 4% with a dividend payout ratio of 25%, this is amazing. This 4% yield is, fairly reliable here, and I don't expect them to cut down on it anytime soon. With a dividend payout ratio of 25% even after the net income decrease here, that's really, really good. So the numbers here are looking pretty fair. And what I want to do next is, of course, take a look at our stock evaluation tool, which will tell us whether it's worthwhile purchasing the stock today at its current price, or we should be waiting for a better valuation. Of course, we have our handy periods here and our handy revenue, net income, and free cash flow projection. These are not projections, they're historical data from 2017 and 2021. But we have our averages here as well, and with the help of these, we're going to make our projections. Now, the revenue growth of the company has been a little bit all over the place. past year was negative growth here in terms of revenue, which you would kind of expect. This is a big, very, very big company, and so they will never have increasing revenue growth like forever. That can't happen. So what we want to examine here is what kind of estimates we'd like to set it up for. So what I would do is take a look at the 5-year, 3-year, and last year. Of course, last year I wouldn't pay too much attention because it's probably the odd one out. Again, it probably had a lot to do with the pandemic, I'm assuming. Although I would expect them to grow their revenue, frankly speaking, in terms of the things that they were selling that were based off of the pandemic, like tests and things of that sort. But generally speaking, they seem to have lost a little bit. Okay, I'm gonna be relatively conservative here as well, and I'm gonna go 1, 2, and 4 for our revenue growth. The net income margins are very low as well. You will see that they are pretty much 1, 2, and 3 is what you'd want to set here. And the free cash flow margins, this is where things get better. They typically have great free cash flow margins compared to the net income that they are making. That's good. So we're gonna go 90, 800, and 110 here, and a 13% annual return is what we typically want to be making. Let's hit calculate, and you will see that based on our current price, our low estimates are a little bit far, yet our low estimates are based off of 1% revenue growth and 1% net income margin. This is probably low because the 5-year average has been about 2 to 3, but it's the conservative estimate again. I think that the medium one makes the most sense really because it's 2 and 2 and it's still more conservative than what they were doing. And again, we have numbers that are very, very similar to each other. This is good. We have reliable numbers that tend to be consistent from year to year. And our medium estimates here are pointing to about $45, which is very close to our current price, 47.46. And our high ones are way higher. They're at $80, while our stock price is at 47. So what I think about Walgreens is I think that Walgreens is an interesting opportunity here, and I would potentially look to add a little bit to a portfolio that's especially aimed towards getting some nice passive income with the dividends that the company is paying shareholders. Again, because they are fairly safe here. Remember that when we examined the dividends here, they were sitting at 25% payout ratio. This is very, 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 very safe dividend here. And this is why I would think that Walgreens right now is a potentially interesting company to add to a portfolio. And you can have it sitting there for many years, adding 4% to your gains, really. And that will, amass some shares, if you are using a dividend reinvestment program over the years, or just some plain income that you can use for buying other stocks or whatever you like. So I think that while Walgreens is not like super undervalued, it's still fairly valued to maybe a little bit slightly undervalued. So I kinda like Walgreens here. I hope you enjoyed the video. Please leave a like if you did and subscribe. At some point I will be giving access to this tool and you may want to stick around, learn more about this. And in the meantime, if you enjoyed this video, take a look at the one that I made earlier. It's about a relatively unknown company, Stone Co. is the name. Take a look at it, and I think you may enjoy this kind of analysis. Thank you for watching this one, and I'll see you soon. Bye bye.